Section 18.1 deals with our cash flow analysis statement, and we'll be taking a look at what has to happen for a business to know where their money is coming to and going out. So when we look at our cash flow analysis, we have to go through and we have to be able to analyze from our owners, creditors, and other interested parties what is happening with our business. And that includes the potential to produce cash in the future, judge a company's ability to pay bills and repay debts, explain changes in our cash account balance, and be able to evaluate the company's investment in equity transactions. So we have to go through and be able to know this information for our business. So we do that by looking at our actual cash flow statement, and this is what our cash flow statement looks like. We can see in the very top we have cash flow from operating activities, we have cash flows from investing activities, and then we have cash flows from financing activities. So our statement of cash flows is really going to be divided into those three sections, and we're going to have to go through and take a look at those. The definition of a cash flows is the cash receipts and payments of a business. Okay, they're going to be summarized into our statement called a statement of cash flows. When we take a look at our cash flows, we can see right here that we have cash balance at the beginning of the period of $12,570, and at the end of this fiscal period, we have a cash flows of $8,435. So we have to take a look at what is happening with it. We have money coming in, and we have money going out. One reason that we prepare a statement of cash flows is to determine, is there going to be enough cash on hand to pay our bills? We have to identify the beginning and ending cash balances. We actually went down on this cash flow statement by $4,135 during the fiscal year. That means that our business here, Snow Creek, used more money than was received in. We prepare our income statement and balance sheets using the accrual-based method of accounting. And when we take a look at a cash flow statement, basically it is prepared using the cash basis of accounting, and we have to understand the difference between the two of those, the difference between accrual and cash flows. And that's going to be one of the things that we're going to take a look at next, is going through and seeing what the difference of our accrual and cash based is. So when we take a look at this, accrual versus cash, basically the main difference between accrual and cash is going to be the timing of when things are going to be recorded. When we take a look at this information here for the Lomax Corporation, you can see under the accrual basis we have a net income of $25,000. Under our cash-based business, we have a net income of $0. Basically, what we're taking a look at is Lomax recognizes revenues of $25,000 when the sale on account was earned. So basically, we go through our business, we have a customer walk in, and they go through and they say, hey, I'm going to buy this, but I'm going to pay you later. Under the accrual basis, the moment that sale is made, you're going to recognize that revenue. If we're going to go through and do it as a cash-based, we're not going to record anything because we're going to go through and record it at the time that the actual money was received, not at the time that we sale on an account.
Now we're going to take a look at what would happen when we compare the timing of expense recognition in accrual versus cash basis. So when we take a look at it, the same thing for our Lomax Corporation. We have accrual versus cash. Accrual, we're going to go through and we'll record our expenses at the time that it would happen. So for example, if I went through and I called somebody to come through and do repair on the copy machine. They walked in, they repaired the copier, and they gave me a bill. At the time that I received the bill, I would go through and record it as an expense. And that's what we're used to doing for the accrual basis. But we can also have an option of going through cash basis. And when we talk about the cash basis, that's really how we go through and analyze what is happening when we prepare a statement of cash flows. So here, how is the difference? Again, accrual is recognized at the time the expenses occurred. So we would go through, we have revenues of $25,000 from the previous example, and now we have expenses of $3,000 for that copier, so now our net income is zero. When we take a look at our cash basis, if I physically have not paid that expense yet, I'm not going to record it. So again, when we take a look at our cash basis for expenses, I'm going to record that at the time that I physically pay it, not at the time that I'm going to go through and occur that expense. So it's going to impact your cash flows just a little bit differently. When we take a look at our statement of cash flows, when I looked at it before, there are three separate categories on there, and it's operating, investing, and financing. So our operating activities are basically the cash receipts and payments necessary to operate a business on a day-to-day operation. So when we take a look at, these are examples of sources of inflows or money coming in for our operating expenses, and these are going to be cash outflows or reasons that our money is going to go out. So we have advertising, interest, payroll, utility, income tax. And again, we're going to be recording these at the time that they actually occurred, not at the time that we recognized it, so at the time that we physically pay it. When we take a look at our next one, our cash flows for investing activities, cash receipts and cash payments involving the sale or purchase of assets used to earn revenue over a period of time is going to be considered investing activities. And here we have a series of typical activities that could be included in investing activities. Examples are going to be purchasing of buildings or furniture so we can conduct business operations. When we go through and do investing activities, it's a strategy to generate sales and profits. Cash receipts and cash payments related to the sale and purchases of assets are used to earn revenue over time. So that's why they're called investing. I wouldn't expect that if I bought a new building that's going to dramatically impact my net income today, but over a period of years we should have increased profits, which then would increase our cash coming in. Our third activity that we deal with cash flows is going to be our financing activities. Cash receipts and payments involving debt or equity transactions are called financing activities. Most companies need cash in order to start the business and to maintain operations. Financing activities involving borrowing money from owners or borrowing funds from creditors are going to be in the realm of investments, dividends, or cash payments. Generally, financing activities are identified by noting an increase or decrease in long-term liabilities and certain stockholders' equity accounts. So here we have examples of those types of financing activities. We may find that some financing activities actually do reduce our cash balance, and that's going to be when we use cash to pay our dividends. And dividends is how much that we're paying to our stockholders. Another way that we could negatively impact our cash balance would be the repayment of a loan or possibly the purchase of treasury stock. And again, treasury stock is stock that is out there and owned by some stockholders, and then we buy it back so that way the company has more investment into the business. So we take a look at our terms here for section 18.1. It's not a very long section, and we'll go ahead and start taking a look at Work Together 18.1. Here is our Work Together 18.1, and we're going to have our cash flow transaction represented. Our selected cash receipts are inflows, and our cash payments are outflows for the Los Altos cyclery. We have a blank form, and I'm going to guide you through identifying the following problem. We're going to identify each transaction as a cash inflow or a cash outflow, and as operating, investing, or financing activities. So we're going to go through and take a look at those and mark them either as inflow or outflow. So it's going to be one of these two. Does it go in? Does it go out? And then if it is one of these two, is it going to be operating, investing, or a financing activity? So receipts issued from the sale of stock. So receipts, that means we're going to be getting money, so we're going to go ahead and say yes. So now when we take a look at receipts from the issue of capital stock, operating, investing, or financing. And again, we have to think about those three things. Financing is going to be what we do when we deal with operating or generating equity. So it's going to be on this one. So cash purchase of office equipment. So cash purchase. So that means it's going to be money going out. Okay. And we talk about office equipment. That's going to be investing activities. So we're going to try to generate more equity from our long-term assets. Dividend payment. Money going out payment. So it's got to be a cash outflows. Okay. Dividend. I just talked about dividend before, and that's going to be dealing with our financing activity. And that's money that we pay to our stockholders. Advertising expense. Okay. Well, if we have advertising expense, it's going to be a cash outflow. Again, we're betting on the fact that in the long term we're going to generate more sales. And we talk about our expenses like advertising, that's going to fall under our operating activity. Receipts from the sale of merchandise, that's going to be cash flow. And anytime you're talking about the day-to-day business of running and selling our products, that's going to be our operating activities. That's what we do in order just to meet our customers' needs. Receive cash from the issue of a mortgage. Okay, so receive cash, it's going to be mark here. Okay, so mortgage. So basically when we take a look at that, basically we're getting a loan. We're getting some money so we can go through and do things. And we talk about getting a loan, that's going to be a financing activity, and that's going to be affecting our equity. Repayment of our loan principal. Okay, so repayment meaning we're paying it back. It's going to be a cash outflow. And then again, because we're dealing with money or a loan, it's going to go under our financing activity. Purchase of another company's stock. So not purchase of our stock. We're not talking about treasury stock. We're saying, okay, I want to buy some stock in Google, for example. So I'm paying money out, so it's got to go a mark for cash flow out. And this is actually going to be an investing activity, not financing, because it does not deal with our equity. We're going through and we're buying this stock in order for us to have an investment for the future. So we can go ahead and take a look at that. And we should have it all perfect for our work together.